Hello all. The last year has been a great learning experience for Indian investors. The re-emergence of terms like volatility, sector rotation, and even investing style have shot into the limelight as equity markets became roller coasters for investment portfolios. Another key trend was the cyclicality of investments and the need for active and dynamism in one's equity portfolio. To that effect, Axis MF has launched its latest offering, the Axis Business Cycle Fund. But before we delve into the fund, one must understand the concept of a business cycle. My friends who operate and manage their own businesses will very well understand a business has up cycles and down cycles. When you look at the economy in totality, we refer to this as an economic cycle. There are four primary phases of a business cycle, being expansion, a peak, a slowdown, and a trough. Every economy, and by extension business, goes through these phases. How long a phase will last or when it will move into the next phase is uncertain. A cycle is a function of demand and supply. Basic business economics teaches us whenever the supply is higher, you know prices will go down. And when the demand is higher, prices will go up. Such movement is what creates a cycle. This can be found across the smallest of the businesses to the largest of them. So, if one can identify the cycles right, therein lies the investment opportunity. Identifying a business cycle is very much an art of identifying several indicators and then framing a coherent investment opinion. For this, there exists a plethora of data points and indicators. Our job is to cut through the noise and use only those indicators that best represent both the health of the economy and the underlying investment thesis. We currently believe we are in the midst of an expansion and a peak economic cycle. Yes, you heard it right, but hold on. This represents an investment opportunity. Consider the environment. Economic activity is strong but stabilizing. Interest rates have risen. Companies are ramping up production to meet the growing demand, but are also investing for the future. Now, understandably, certain companies and sectors perform differently in each phase of an economic cycle. Some are better equipped to weather a particular economic phase, while others underperform in it. For example, defensives like pharmaceutical companies tend to outperform during the recessionary phases, while cyclical companies like automakers tend to do well when the economy is expanding rapidly. A typical business cycle fund tries to identify the current phase of an economic cycle, narrows on the sector that can outperform in that phase, then chooses within those sectors. But while the economic cycle is important for mature sectors, many sectors are affected by industry-specific factors that result into their sector cycles being different from the economic cycle. The Axis Business Cycles Fund tries to capture opportunities brought on by changing economic cycles as well as individual sector or industry cycles. It seeks to identify and invest in companies with favorable business cycle tailwinds. Why a business cycle fund now? The domestic economy is in a very interesting phase right now. The onset of the COVID-19 pandemic made matters more challenging amid the NBFC crisis pre-pandemic. However, things have started to look up. The post-COVID phase, as we stand at the cusp of a new capex cycle, balance sheets have strengthened across large companies. Domestic demand is robust and there are increased focus on PLI schemes, which can boost capacity addition, and there is widespread digitization offering a strong impetus to the economy. This may be indicative of being in the nascent stages of expansions. If consumption was the primary driver for economic growth in the last decade, investment led by capex and manufacturing could also be the growth driver for this decade. In such an environment, both B2C, that is consumption-led businesses, as well as B2B, which are more cyclical, can do potentially well. So how will the Business Cycles Fund work? The fund will have a cyclical driven approach. In the expansionary times, we would focus on building a cyclical sector-based portfolio of companies which could benefit from an impending favorable upcycle. During the slowdowns or uncertain times, the portfolio would tilt towards countercyclical themes or companies that would be in a better position to navigate in tough times. Contrary to our traditional bottom-up approach of investing, this fund will employ a hybrid approach of investing. This means a top-down approach to identify the economic trends, or more importantly, choose sectors ideally suited to benefit from their business upcycles, and then use a bottoms-up approach to identify particular stocks who would thrive above the rest within the identified sectors. Further, the fund will follow a dynamic approach with no market bias. It will have flexibility to be more aggressive in terms of overweight and underweight across sectors, which means when we find an opportunity in a sector, we will try to build a bigger position in that sector, showing our high levels of conviction. And then, equally important, try to cut our weightages as the investment story plays out, and we move to the next sector with an imminent favorable upcycle. Should you invest in this fund? This fund is suitable for investors who are aiming for long-term capital appreciation by riding business cycles. It offers considerable diversification in one's portfolio in terms of sectors as well as themes. The NFO dates are mentioned on the screen. Consult your mutual fund distributor for more information. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.